Interesting risk dynamic week we've had here, right? Everyone is probably wondering, well, what's going on? Dollar has been bouncing, commodities ripping, bonds drifting lower, equity is kind of in a standstill, right? So I'm thinking we're gonna go over some of those things in a few minutes, but let's just look at equities first. And Nasdaq's looking all right so far. I mean, we're still in a bullish trend, right? And we're holding mid vamp. So as we like to say, when something's in a bullish trend and holding mid vamp, the base case is that upward pressure, new highs can pursue here. So this is something that it's possible for equities to go up. We have our thesis on what should outperform, but equities don't look terrible from a trend and price perspective.
Yeah, well, the Nasdaq's been struggling to get to new all-time highs while the S&P has gotten there. And why do you think that dislocation is happening? What's making the S&P more favorable than the Nasdaq at the moment?
Well, I do think that there's some obviously have some lagging tech stocks that are going to be more influential in terms of price price discovery and or I should say preventing price discovery to the upside when you got names like Google that are still down and stuff like that, which are Nasdaq components, right? They're obviously S&P components, but Nasdaq's just more tech weighted. The other thing is, I think the regime that we're in, it's very obvious that we're not in a hyper risk off regime. I do think the regime is risk off, but I think it's such a dynamic risk off regime. We've been speaking about this where you're in a position right now where you can see both risk on and risk off assets rise. And as we just said, like equities don't look terrible. Nasdaq's holding, and as you just said, SPY's already at new highs, and tech is something that typically underperforms in risk off areas or risk off regimes, I should say. Right, tech tends to underperform, which is probably what's contributing to that. If we take a look at SPY, right, SPY Nasdaq outperformance, the SPY Nasdaq outperformance as of late is, or the inability for the Nasdaq to outperform the SPY, I should say, is likely due to the regime that we're in. But it's not hyper risk off, and what I mean by that is it's not like I'm not saying it's anything crazy. I'm just saying we're in a situation right now where risk off doesn't in general risk off doesn't mean crisis. A lot of people think, oh, risk off, everything's going to hell, right? That's not what that means. That tends to be the case, but I think we're in a position right now where rates have downside risk. I know as you're listening to this today, and maybe NFP gives us a little shock tomorrow. We'll go over that too in a couple of minutes, but you might be saying, no, it's all over. Rates are going to run. And, this is the lows. It's only up from here on rates, right? I do think that's just not the case yet. Rates do have downside risk, but I don't think equities necessarily have the same risk that's normally associated with rates falling steadily and consistently. I think you're in this position right now where rates can come down, bonds can go up, but equities can go up too in this risk off. Now, some people would not even want to classify that as risk off. The only thing that classifies it as a risk off regime would obviously be risk off assets outperforming risk on assets, right? And we've seen a very a very noticeable shift in that risk sentiment lately. And we spoke about that last week, where we saw a bounce in risk off in risk off probabilities, or I should say, a reacceleration of risk on probabilities that weakened the risk off structure a bit. But it hasn't really taken us out of there altogether. If we take a look at something like the SPY to TLT ratio, right, and we just take a look on what's going on here, as you can see, this is not breaking new highs just yet. It's definitely up off the lows. It looks like we could be going up, but we're not at new highs yet. So theoretically, since July 1st, bonds have still outperformed equities.
Yeah, we're
And
we're kind of like in this middle ground where we are in risk off, but nothing is really breaking. Whereas during risk off, the odds of something bad happening, some bad news coming out, is elevated, but we're not really seeing that. So we're kind of like teetering on the edge of risk on and risk off. Is that what you would
Ex-
say is happening?
100%. I think that's a great way to put it. Whereas like equities can go up, but so far since our pivot, we've seen more alpha in bonds, right? Or there has been alpha in bonds versus equities. And I think that should persist. Now, some people may have different opinions, and we could talk about bonds right now. If we take a look at bonds, I do think some key levels have been neglected here or shunned away from, and they need to be broken to the upside to really get the bond trade moving again. Otherwise, we gradually will lose that bond alpha that we just talked about, and may get to the point where bonds and equities are balanced, and then equities start outperforming bonds, and we start likely at some point around that time, our system, which is not derived based on what bonds or equities are doing, right? It's a separate model. And that model will likely at some point flip before any major moves in the market happen. This way we can position ourselves to take advantage of it. But up until we even get to that point, which is that's down the road. Right now we have to focus on what's here, and bonds did not break mid-vamp. So the system's obviously signaling risk off, right? That's just what it is. If you want to know what regime we're in, that's simple. Just go to the quant deck in the members area on our website or Discord, and you can find the daily breakdown of what regime percentages, what the regime percentages are, and where we are in the cycle. But ultimately, risk off, right? Bonds need to break above mid-vamp here to get a reignition here on this bullish trend. As we just stated, look, price above mid-vamp in a bullish trend in equities is supportive, whereas price below mid-vamp in a bullish trend leads to consolidation and chop. So think of the trend being where, you know, the upper the range high is, the high of the range, and Momo. Consider that all like the bullish trend. So if we're under mid-vamp, we can consolidate in that entire area, meaning price can technically slide down to Momo. That would be pretty uncomfortable, but it's possible. Do I think that's the base case? No, I do not think that's the base case at the moment. So given that we're here, the next question you have to ask is, well, why didn't bonds break mid-vamp? And there's a lot of things. Obviously, we had this whole war thing, this whole Middle Eastern conflict. Some would claim the port strikes were a driver. I don't think the port strikes were nearly as much of a driver as the overseas headlines. And really commodities, right? So the reason bonds have suffered, in my opinion, is we've seen a strong reversal in commodities, a really strong reversal. And to be honest with you, the reversal is so strong in commodities that I would have thought bonds would be lower than where they are right now.
Yeah,
Like,
they really don't seem to mind too much. I wonder if it's just because this move in commodities, mainly being crude oil, is due to that Middle Eastern conflict that's happening. It's not really due to growth issues or
I'm sure
core
that I'm sure
deeply rooted inflationary issues.
I'm sure that's probably what it is. I mean, I don't like we saw commodities rally the other day with bonds at some point, so they're obviously not inversely correlated at the moment, right? So it's pretty clear that bonds don't care too much, but I do think that the way commodities are moving scare the bond market a bit. It's holding the bond market back, in my opinion, right? And I drew these ranges on this chart, and I posted this on X a few times over the last week. And these ranges still do stand. I know we're just in a matter of days, we've gone from, you know, mid-range all the way up to this upper end of this red line here, which is a risk range. Above this, we have a problem, right? This is where inflation acceleration headline risk grows and becomes problematic. But I also think we've gone up here so fast. The question is do you get some sort of exhaustion move here, or is this going to roll over and are we going to go back to, you know, mid-range commodity prices? I think the question is, do you hold above this red line and then start basing up, or does it look something like this where you get a master pump through it, or an aggressive pump through it, and then it's just fade back below? Is that what we're going to see, or are we going to see something like this, right, in 2022, where we break through it, we pull back, and we can trend higher? I don't think the base case right now is higher commodity prices. I do think that We'd have, for me to get concerned of this 22 level on GSG, we have to get above and actually hold. I'm almost thinking at some point here there'll be a short-term reversal. I'm not too scared. And ultimately, I think that bonds are getting kind of to the point now where, they've been beaten up a bit here, and it's been one of these things. I think we speak about it in the last podcast, how like all this not so bearish data keeps coming out, and bonds kind of have held it together to the point where it's like they haven't really unloaded, right?
Yeah.
Like,
Yeah, it's like there is something propping them up, and I think what's propping bonds up is the probability of the slowdown being very rooted in. I think bonds are just fully pricing in a slowdown pricing with the possibility of that slowdown turning into a recession if the Fed doesn't cut enough. And I think that's why bonds are staying elevated to this level.
yeah, that's probably like a premium. I could see what you're saying. You're basically saying that that's a premium that's holding bonds up, even though the data we almost seem to be gradually lifting out of this slowdown, right? Which is something you can't ignore, right? Like that's something we have to look at. Like, will growth risks or growth strength reaccelerate flipping the regime? And that's totally possible. We have to be open and humble about how we read the market. The system will guide us, as it always has throughout the last couple of years, and we just have to take the signals as they come for face value. Now, what I will say is some people are wondering, well, I'm long bonds. Like, we are long bonds, right? We've been long bonds for a while now. We've made this clear on X. We've made this clear in our podcasts. We won't tell you exactly when we exit. That's obviously for the members, but we are long bonds, right? Now, the RQF, which is our Radar Quant Fund, which has all of our 3 models running simultaneously in one portfolio. Simply put, it's just basically one portfolio, all of our stuff ready to go. It has an average drawdown of about 9.6%. Now, it's got a max drawdown of 33%, going back to 2016. Right now, the RQF is down about 9%, 9-ish percent off the highs. So the RQF's in about a 9 to 10% drawdown. Now, what makes that interesting is we're getting to the point where the RQF is at a position where you're almost, if you follow the RQF and you're a member, you're listening to this, you understand what I'm saying already. But if you're sidelining, like, this is the point where if I have extra capital, what I'm doing is this is the perfect time to position, at least for me, into RQF. And obviously I can't tell anybody what to do. Our RQF is just a hypothetical model, but like, I'm looking at this like I'm saying, okay, the RQF's on a 10% drawdown. This is a perfect spot for me to add fresh capital, right? So if it means bringing up my NAV by capital contributions and then reweighting my portfolio, it's a good time to do it. Is it guaranteed just because we're down 9% on average that this is the low? Like, that's it? We're not going to go down any further? No, like that's retarded to think that, right? Like, that's obviously not how this works. But you kind of want to take these discounted value periods as opportunities if you can. And if bonds do go up to back up to highs at some point, then you would thank yourself if you did that. Or if the regime pivots, you have new capital to play with. Now, that shouldn't be, again, you guys got to manage your own risk, but when you look at the model like this, you have to also think, look, the RQF has periodic drawdowns just like anything else. Are we stressed about the drawdowns? No. I'm personally adding to it, so I'm taking advantage of it. But again, you have to handle it on your own accord. Now, speaking of bonds being, the RQF being down 9%, 10%, and bonds being down alongside us, so bonds pulling back off the highs that were made on September 17th. What is going on now with bonds? As we said, they have to get above mid-vamp, but we have something else that's going on. That's going to be the NFP report, the jobs report tomorrow morning. The jobs report tomorrow morning will most likely move the bond market. There's a chance it doesn't, but it most likely will. Do I have a feeling that bonds could see a little bit more of an unload to the downside on NFP? I do, but the thing that's holding me back from saying that is the jobless claim numbers have been considerably improving, and the ADP report we got on Wednesday was not really, but was a beat, was good, right? In terms of the at least the seasonally adjusted figures, which is what the market cares about. So all good signs from labor market lately. It makes me think that maybe with the commodities moving up and the good labor figures coming out, the bond market's already kind of put in a premium of a good jobs report, right? Rates are kind of edging on the side of a decent jobs print. So anything that maybe is not at the upper end of consensus would give a bounce to bonds. That's possible. But I do think bonds are just weird. I wouldn't be surprised if we got lower vamps. So you have to be positioned to, like, at least I'm always positioned accordingly with RQF. I'm never going to be too leveraged to the point where it's like, oh my God, like I'm liquidated, right? We have to manage our risk, and we trade with what we manage our portfolios with what we're willing to lose type of thing. So I'm willing to, I'm willing to sit, like, obviously handle a move down. Is it going to be a comfortable one? No, but it's just something that I think is possible. Not likely. I do almost feel it's a mixed situation because, again, I think for bonds really to go down significantly from here, we have to have a labor print that is at the upper end of consensus. Anything else, I think bonds are flat to upside. That's my take on it tomorrow. What do you think?
Yeah, and I think it really depends on more data coming out that growth is really on the mend, and we are coming out of this growth slowdown that we've been seeing and that bonds have been pricing in. Once we can see that there's a reversal in that and we actually do start heading towards either an inflationary or expansionary regime, I think that's what's going to be what ends the bond trade.
Yeah, so I think you're pretty dead on there with the growth, right? Like growth is obviously the determining factor because you can have a regime, and we went over this at the beginning of the podcast, or at least I brought it up, where bonds and stocks go up, but bonds only outperform stocks if that growth strength is not sufficient enough to carry equities up faster. So if that growth strength shifts, right, along the way, and you get a point where you go from negative growth strength to positive growth strength, aka from risk off to risk on, what's going to happen then is equity should start to accelerate and really start outperforming bonds. But until that really happens, you're stuck in a position where bonds should carry their weight. And that's my opinion on that. And let's actually, since we're talking about labor, let's look at labor real quick here. So I have a chart with two lines on here. Number one is a black line, and that is the year over year change on the unadjusted non-farm payroll figures. So we simply look at the non-farm roll total figures, not what's added or what's lost, the total non-farm payrolls, and we take a year-over-year percent change on those figures. And then on the red line here, I have the unemployment rate. Now, the reason I chart these two together is there's just a simple, and this is very smooth-brained, but it does make sense, and it's something that I think we ought to talk about, that when the non-farm payroll growth rate falls below 1.5%, typically it's met with unemployment that goes up pretty considerably, right? So, you can look back in the 90s, look back in 2000s, look back in obviously 2006, 2007, 2008, and you can even look back here in 2019. What you'll notice is once we fall below the 1.5% mark, the unemployment rate does hit a somewhat of a maximum. Now, we go back in time, pretty much every time we break down below 1.5% on NFP, on total NFP figures, unemployment rate rips. We are just on the cusp. We're at 1.47. Now, this chart right here on X would be an easy macro bear porn post, right? Just blast this around, boom, unemployment, the bomb in unemployment's coming. All these people would run this chart out of the ass on the internet because it's such an easy linear chart. But that's not what we're going to do because we're not even that's just nonsense, right? We're going to focus on where we are right now. Just because we're below 1.47, 1.5 at 1.47, right? We're 3 basis points below does not mean a crisis is necessarily coming. We have to look at this from a base perspective. So the way I look at it is tomorrow we could get the update and this is back above 1.5, maybe looks good or goes lower. I think that's what I'm going to be focused on tomorrow, see where NFP growth rate is rolling on a total basis. And I do think that if we do accept and start drifting considerably below, I would even give this a 10 basis point buffer. So say 1.4 is probably where things start heating up for unemployment. If we can fall below 1.4 on these NFP figures, on the NFP growth rate figures, I do think unemployment will start to get more and more headwind or more tailwind, and that headwind to the downside or resistance will kind of fade. Right now, though, I think we're in a position where anything can happen. We could be, basing here, like we've seen this happen before, like look at 2012, 2013, right? We don't really break below, even here in 95, right? What you'll notice is the unemployment growth rate, the employment growth rate went from 3.5% down to literally 1.5% in a matter of a little over a year, a little under a year. And you'll notice here the unemployment rate stalled out. It wasn't able to really fall further until this rate was like reversed its course, and then unemployment can fall again. This is not a perfect indicator. This is not this is just, again, smooth brain observation for those that maybe don't have access to a lot of data feeds. Maybe you're not even a member yet. You're not seeing the quant deck every day. You don't have that data depth insight, at least not yet. And you want something quick and simple to look to, kind of like the commodity lines that we revealed, these barriers. This too was a very simple and easy to understand relationship. If the payroll growth rate falls below 1.5, theoretically, unemployment should lift and have tailwind. So we're going to be watching this rate tomorrow. We'll tweet about it. So that's really it for unemployment, guys. We'll see you guys on X tomorrow. Thank you so much for listening. If you have any questions, feel free to reach out to us on X at The Market Radar or go to our website at market-radar.com.